With all the volatility in the stock market and the uncertainty about the coronavirus, some are concerned that we may be headed for another housing crash like the one we experienced in 2008, and the feeling is understandable. This real estate market is nothing like 2008, and I'll be talking and showing these 5 visuals to illustrate the dramatic differences. 1. Mortgage standards are nothing like they were back then. During the housing bubble, it was not difficult to get a mortgage. Today, it's tough to qualify. The Mortgage Bankers Association released a Mortgage Credit Availability Index, which is a summary measure that indicates the availability of mortgage credit at that point in time. Now, the higher the index, the easier it is to get a mortgage. And as you can see, during the housing bubble, the index skyrocketed. Currently, the index shows how getting a mortgage is even more difficult than it was before the bubble. 2. Prices are not soaring out of control. Here's a graph showing annual house appreciation over the past 6 years compared to the 6 years leading up to the height of the housing bubble. Though price appreciation has been quite strong recently, it's nowhere near that rise in prices preceding the crash. There's a significant difference between these two periods of time. Normal appreciation is about 3.5%, so while current appreciation is higher than the historic norm, it's certainly not accelerating beyond control as it did in the early 2000s. 3. We don't have a surplus of homes on the market. We actually have a shortage. The month's supply of inventory in order to sustain a normal real estate market is approximately 6 months. Anything more than this is an overabundance and will cause prices to depreciate. Anything less than that is a shortage and will lead to continued appreciation. And this next graph shows that there are too many homes for sale in 2007 and that caused the prices to tumble. Today there's a shortage of inventory which is causing an acceleration in home values. 4. Houses became too expensive to buy. The affordability formula has 3 components: the price of the home, the wages earned by the purchaser, and the mortgage rate available at that time. 14 years ago, prices were high, wages were low, and mortgage rates were over 6%. Today, prices are still high, wages, however, have increased, and mortgage rates are in the mid 3%. That means that the average family pays less of their monthly income towards the mortgage payment than they did back then. 5. People are equity rich, they're not tapped out. So in the rise of the housing bubble, homeowners were using their homes as personal ATM machines. Many withdrew equity once it built up, and they learned their lesson in the process. And according to Keeping Current Matters, prices have risen nicely over the last few years, leading to over 50% of homes in the country having greater than 50% equity. But owners have not been tapped out in their equity like they did last time. Here's a table comparing equity withdrew over the last 3 years compared to 2005, 6, and 7. Homeowners have cashed out less than $500 billion than they did before. During the crash, home values began to fall and sellers found themselves in a negative equity situation where the amount of mortgage they owed was greater than the value of their home. And some decided to walk away from their homes, and that led to a spike in distressed property listings, which are foreclosures and short sales, and they sold for huge discounts, lowering the value of other homes in the area. So to give you peace of mind, that cannot happen today. Hey guys, did you enjoy today's episode? Because I sure did. We unpacked a whole lot today, and I hope that all this data helped clear up any mainstream misconceptions. If you'd like to dive deeper in regards to today's market and where it's heading, send me a message. Thanks again for watching. As always, I'm Mario Albañez, signing off.